All right, all. Thanks for tuning in. So I was just listening to a recording of me, and I find it quite annoying because I say "but anyway" or "so anyway" all the time. As I was just about to do it there. As someone who is in the media type thing here, I'm going to try to stop doing that. So I'm going to hang up the sign I have in front of me here that says "no ums, no ahs," and now we're going to put on there anyway. So anyway, let's get into that. Just kidding. All right, spy moving ahead here. Not surprising. Actually, it is quite surprising. However, there is something I want to draw your attention to. I am so tempted to say but anyway or so anyway, but I'm not going to do it. No one's been talking about this. The yield curve has uninverted. All right. Oh, was just about to say it. Boy, it's not easy to do. You get your habits and they're hard to undo. Now, an inverted yield curve over the last 50 years has happened, I think, 9 or 10 times, and it's preceded all but one recession. And the recession comes when the yield curve uninverts. Now, you're probably like, what is a yield curve? In the financial markets, you need to be rewarded for risk. So if you're taking a position in a bond that has, say, 10 years, a 10-year maturity, versus a position in a bond that has a 2-year maturity, the 10-year maturity is going to be more risky because within that 10 years, there's a lot more things that can go wrong. When people start to really freak out about what's going to happen, boy, I'm having a hard time with this here. When people talk about when people are thinking the market's going to get weak, what do? They they sell their short-term bonds and that drives the price up, and they buy long-term bonds and that drives the price down. So when the selling of the short-term bonds goes down far enough, it's going to make the yield high. When the buying of the long-term bonds, when the buying goes up, it's going to make the yield go down. When the short-term yield, which historically should be lower than the longer-term yield, becomes higher, we call that an inverted yield curve. And as you can see on the chart here, going back to 1993 here. So almost about to. The yield curve has only really been inverted 3 times, and recently, over the last say year or two, it's the worst. It's the most it's been. March of 2000. This was the market peak, the internet bubble peak. Massive recession after that. December of '06. This was the right before the housing bubble slash meltdown then, which I remember very well. And we've been inverted over, we're going to call it the last, say, year and a half or so. And we have uninverted. The 10-year yield is now back to being higher than the 2-year yield, which is how things should be. But this unwinding is usually what precedes the recession or a recession. That's just something I wanted to point out. So, uh, boy, it's hard to do. SPY moving higher here. Let me find around. Oh, it's kind of interesting. Just looking at this Carnival Corporation. I would say that this is probably my main thing I'm looking at now here for a trade on the short side, which means buying puts. Don't short stocks. I don't short stocks. I've never shorted a stock in my personal past, I guess. I've done it many times for institutions, but that's not my money. It's just kind of dangerous because if if I'm going to take a position on the downside and I'll buy a put, so the most money I can possibly lose is how much I spent on the put. If I spend $100, that's it. I can't lose more. If I go to short a stock, like let's just say I shorted Carnival, like literally shorted the stock, and then on Monday it gets taken over at $40 a share. Guess what? I sold it at 20. I got to buy it back at 40. That's a big loss. Oh gosh, I'm trying so hard not to say it. Ah, overbought. I think we're when something gets overbought, it means it's basically just trading at what would be way above its usual or typical trading range. A lot of Wall Street trading strategies are built on this concept of reversion to the mean. So there's a good chance this draws sellers into the market and they could push it down. Now, where would my target be to close out my short position? Notice this price level down around here was resistance, right? This is even goes back farther. This is we're going to call it 1930 was resistance here, resistance here, resistance here. Price levels that were resistance can become support. You can actually see it right here. Resistance here became support here. This is due to seller's remorse. There's people who sold and they regret doing so when the price goes higher and they say if it ever gets back to my selling price, I'm going to buy my shares back. So people who sold at resistance who get remorseful after the price goes higher tend to put in buy orders when the stock gets back to their selling price. And if there's enough of them, it can create support. So if we do reverse, I said, well, I didn't say so anyway. If we do reverse, that's going to be where I close out my position. It's about $1.20 move. And as you option traders know, in a market, that's a big move. And I think it could happen pretty quick. I think it could happen over the next couple of days. Trying hard not to say it. I'm just going to throw in there. So anyway, that's all I got. Thanks everyone. Please, yeah, check back in, send me emails, tell your friends. Trying to get up to 1,000 followers. That would be great. And I appreciate your time.